Welcome back, class. This is the Chapter 10 video that I promised, and in this video we're going to talk about reporting and analyzing long-term liabilities. When we're talking about those liabilities, one of the biggest liabilities that we're going to see is related to bonds. And bonds are a way of getting long-term financing for large capital projects. In this chapter, they begin with the definition of what a bond is, and really it is a promise to pay the par value or face value on the bond along with interest to whoever the bondholder is. The par value of the bond or the face value is typically $1,000. They show this here in the advantages of bonds. One of the advantages they describe is that bonds don't really allow the bondholder to exercise any voice at all in the business because they're not an owner, they're a creditor. So with this change in roles, a person who buys bonds and helps finance these capital projects will own a slice of the debt of the entire bond issue. So each bond has a value of $1,000 typically. And then there's a stated interest rate on the face of the bond, and always there's some recognition of the term of the bond. So this basic identification of a bond will look like this for a lot of these. So they'll say, $1,000, 11%, 20-year bond. That'll identify it. The advantage, like I said, is that the owner of the bond really doesn't have any ownership in the company, and they don't require, they're not allowed to vote for board of directors, and there's no dilution of the stock value or additional shares of stock that are issued. Also, another advantage is that the interest is tax deductible, so that you have a tax advantage on the payment of interest on those bonds. One of the things about bonds, and this is both a benefit and a problem possibly, is that there's leverage involved. And through this financial leverage, you can both increase return on equity and have it decrease. Here they show you how the return on equity can increase with bonds. And basically it increases because what you're doing is you're increasing net income through capital expansion, but you're not increasing the level of equity, that is the stocks that are out there. So in this case, your basic net income is larger, but divided by the same amount of stock that you started with. So you really don't have an increase or a decrease or a dilution of that return on equity that you would have if you issued additional stock. So the disadvantage is that can also come back to be a difficulty if, instead of an increase in income that you have over here, you wind up with a decrease in income. So if your return or if your income that's generated is coupled with the continued interest payments, it doesn't come up to the anticipated or planned or budgeted amounts, you may see a decline actually in the return on equity. These will also require periodic payments of interest. So that's also a disadvantage, because with shares of stock, you can pay dividends, but you don't have to. Most of the time, that's an optional choice. Okay, so with bond issues, what we're talking about is setting up a legal document that's called a bond indenture, and that's an agreement with the bondholders, and the bondholders will purchase these bonds after reviewing something like this bond indenture, or typically a prospectus that goes along with the bond issue that details the legal terms of this bond indenture. And a prospectus for a bond issue is required by the SEC. These bond issues are typically quite large. They're not very small because there's a significant amount of cost involved in issuing them. So each bond has a certificate many times. This is kind of an example of what a certificate might look like. The bond will give you all of the information related to the bond issue, Many times the bond certificate itself will not necessarily be identified the owner. However, there will be a registration of the owners of bonds, so that you'll have an identification of those bondholders of record at a specific date. Bonds are also traded in the stock market or other financial markets after the initial issue. There may be different denominations of bonds, like they say here, 1,000 or 5,000. But after they're issued, what's going to happen is there may be some people who don't want to wait 20 years to get their money out of it, and they go ahead and sell their bonds that they have, and somebody else wants the investment, so they purchase it from them. Now the question is always on these bond issues, is the interest rate on the face of the bond paying at or above or less than the market rate? If a bond is paying the exact market rate, typically the bonds are going to trade for their face value, their par value. So if the market rate is 5%, the bonds are 5%, they're going to sell for 1,000. If the market rate is higher, if it's 6% or 7% or something like that, these bonds will trade at less than that value. If the market rate is lower, say these bonds are 5%, and they're trading on the market if the bonds are 5% and the market rate is 3%, well, these bonds are going to sell for premium. So when we're talking about those two things, what the bond pricing is going to look like on the market is going to be different from a share of stock. They always express bonds as a percentage of the face value. So in this case, they'll say a bond is trading at 103.5. This is a bond that's paying more than the market rate, more than the market interest rate. And so people are willing to spend a little bit more on it to get the bond. So they're going to pay 103.5% of the face value, which is going to be $1,035 instead of the par value of 1,000. If that bond is trading lower, or if the interest is lower than the market, they may be trading at a lower amount, which will be like here, 95%. So if you're buying a bond with a lower rate of interest, you don't pay the full par value to compensate for that. So in this case, if it was 95%, you'd be paying $950. So when you issue the bonds, if you collect exactly what the par value is, there's not really any big issue at all at accounting. In accounting for them, basically you're going to record the receipt of cash, $100,000. The obligation of bonds, $100,000 in bonds payable. This situation is assuming that a company issues $100,000 of 8% 2-year bonds, and they're dated on December 31st, 2018. In that situation, that is the journal entry you would record. Now, when you hit the first 6 months that you're going to pay interest, you're going to record the bond interest on those bonds. So now notice that the bond rate, stated rate, is 8%. That's per year. So you're going to take the 8% per year and then basically divide that by 2 because you're paying it every 6 months. So every 6 months you're going to pay half of that 8% interest, which means you're going to pay 4% interest on these bonds. First on June 30th, so you pay 4% times 100,000 is 4,000. And then on December 31st, you pay the balance of that interest. Now, when the bonds actually mature, and assuming that you've paid all the interest along the way that you needed to, the payment that you're going to record the payment of these bonds, you're going to debit bonds payable and credit cash for 100,000. Basically, you're retiring these bonds. Now, when we talk about bonds selling at above or below the par value of the bond, that's going to create an accounting issue that we need to deal with. When we talk about the bond interest rate, sometimes that's referred to as the contract rate. It's also called the coupon rate, stated rate, or even the nominal rate. Basically, that's how you're going to compute the interest amount, the annual interest amount. So, like I mentioned a moment ago, if the market rate is favorable with that contract rate or that stated rate or coupon rate, you're going to have, if it's a comparable interest rate, you're going to have the bond selling at par like they show here. So the bond is issued at a contract rate, the market rate is here. If they're equal, the bond sells at par. If the contract rate is greater than the market, you're going to get a premium. If it's less than the market, it's a discount. So when you issue bonds at a discount, what's going to happen is you'll have a stated value on the bonds, and that value will be, let's say, 100,000, like we said before, and you're paying a specific interest rate, but the market rate is higher. So in this case, when they sell these bonds, they're going to get 96.4% on the bonds rather than 100. So what this means is we need to record a discount on the bonds. So we're going to recognize the cash we received of 96,400, the discount on the bonds, which is the difference between the stated value and the cash we received of 3,600, and a discount is always a debit. And then we'll have a credit for the bonds payable of 100,000. Now that really impacts how we report the bonds on the balance sheet, because what we're going to show on the balance sheet is the value of the bonds as of the date of the issue, less any discount that we have to show everybody that this is the net value as of this time of these bonds, the net debt or the net obligation. What we need to do, though, is to amortize that discount as we pay interest payments over time. So what we're going to do with this amortization of the discount is to take the discount and calculate it much like a straight line depreciation. First, we're going to compute the entire amount of interest we have on the bond issue. So in this case, we have at 8%, we're going to have paid at every 6 months, we're going to have $4,000 every 6 months for 2 years. That means that we have 4 payments, because we'll have 2 payments a year. So 4 payments, we're going to have $4,000, we'll have 4 payments, and then we're going to multiply all of that by the face value of the bonds, the interest rate, and the time. And notice that the time here is matched up with what we're paying and when. So if we're paying semi-annually, we want to use 1/2 of a year, or 180 over 360 here. So that calculation then comes out that we have 4 payments of interest. It's going to be $16,000 total. And we're going to add in the discount of $3,600 so that we have a total bond expense related interest expense over the entire life of the bond, from the time we issue it until the time it's retired. That total interest expense is actually going to be $19,600, because what that discount really is a statement that they need additional interest payments in order to take our bonds. So we take that amount and divide it by 4 to arrive at what the amortization will be per 6 months. So every time we make a payment on interest, we're going to record this entry. We want to recognize the actual payment of the interest expense, but also in that transaction we need to recognize the amortization of the bond discount. So we take this number and call this total bond expense, or the bond interest expense that we're talking about, and then we're going to credit the discount of $900, because we are actually taking the difference between $4,900 and the $4,000 in interest that we've calculated based only on this. So the cash payment that we're going to make is actually only $4,000, because it's based on this calculation. We are not going to pay any more than that, because this is a discount. So we're going to pay the $4,000 interest payment, but part of the discount is amortized and recognized here as interest expense, and that's exactly what it is. And in these T accounts, you can see how that process works over time and the transactions that will occur. This is a straight line method that we're looking at here for amortization. This is probably the most widely used and basically the easiest to calculate. So throughout the time of the bonds, we're going to amortize it every year. Well, every 6 months, we're going to amortize that discount until we wind up basically with the discount fully amortized, and that's going to look like this. So you start with a $3,600 amortized amount, and what you're actually doing by recognizing that interest expense is that you are increasing the carrying value of the bonds until you get to the maturity date and you have the actual full value of the bonds. So here you start with $3,600 in discount. After the first 6 months, you add $900 onto the carrying value and subtract it from the discount. After another 6 months, you do the same thing, and another 6 months, you do the same thing. So what this amortization schedule really does is it basically gradually recognizes the using up of that discount, or the recognition of that interest expense that is inherent in the discount. Another thing that you need to know about bonds is that these are typically rated. So you'll see different rating systems like Standard & Poor's, which is AAA, AA, and BBB, so on. Bonds rated in the A and B range are investment grade. Low grade bonds are in the C and D range, and you probably want to be very, very cautious about those. Those are what they used to call junk bonds many times. Okay, so we want to go through this example. I don't want to do the example right now, but we'll work through that in class. The premium on bonds works the opposite way of a discount. So let's say that our interest rate is higher than the market rate, like they're showing it here, 12%. So the market likes that interest rate because they can't get that interest rate anywhere else. They're going to pay us an additional premium of $3,600. So we're selling these bonds at 103.6%. So now, instead of getting less than the face value, we actually get more than the face value, $103,600, and we recognize the premium is going to be the difference between the bonds payable and the cash we received, which in this case is going to be a $3,600 credit. Remember, I said a discount is always a debit, a premium is always going to be a credit. So when you actually get to the balance sheet with this case, you're going to have $100,000 in the bonds payable. You're adding in $3,600 as a premium to show the carrying value of $103,600. Now, instead of being interest expense, this is interest income. And we're going to basically show that as a reduction of interest expense. We're not going to recognize it as income, but basically that's what it would be seen as. But we're going to show it and record it as a reduction of our interest expense. And it's going to be recorded this way. So when we get around to the actual calculation, the amortization, we're going to have the calculation of the interest, which at 12% for 2 years is $24,000. We subtract out the $3,600 premium because we received more than what we were issuing for, and we have a net interest expense to be amortized of $20,400. We use the same method here, and then we wind up with a 6-month interest expense number of $5,100. So based on that amortization, when we record bond interest expense at every 6 months, we're going to record $5,100 as expense. However, we're still obligated to pay out $100,000 times 12% times 1/2 of a year, which is going to be $6,000. So the cash we pay is $6,000. The $900 bond premium is going to be understood as a reduction of that interest expense that we would have. So we're going to basically take that off, or show that as a difference between the $6,000 and the $5,100. So a premium is a reduction of expense, and a discount is an increase of that expense. And again, this is a straight line method, and we're going to basically use that here. and show you how that premium is amortized. And just like the discount, it's going to work the same way, except in the opposite direction. Instead of the carrying value increasing, the carrying value is going to decrease. So we begin with $3,600 in premium, $103,600 as the carrying value, but each year we're going to take $900 off of this. And you'll see the decline in both the premium and the carrying value until you arrive at the actual face value for the carrying value. Again, there's another problem here to show you how it works. We'll go through that later. The next big issue with bonds is what happens when you retire them. Well, basically, you're going to pay the bond issue at its face value when it retires. So you're going to debit the bonds payable and credit cash for whatever that face value is. Now, there are a couple of cases where you can actually have an early retirement of a bond. There are these kind of bonds that are called callable bonds. They're described here, and it gives the company the right to retire them early if there is a call premium involved. So normally a callable bond is going to include a call premium so that the company will have to pay an additional amount over and above what they would normally pay on the face value. Of course, anytime a bond issuer wants to, they can go out into the market and buy their own bonds back, much like they would their own stock, and they can retire them that way. Regardless of which way they do that, we need to recognize what they're paying for the bonds when they retire them. So in this case, let's say they retire callable bonds where you have a premium. So in this call premium, this is actually the premium, which is a call premium, but we're going to show you how that's calculated here. Notice up here they're talking about this par value of the bonds at $100,000. They have a call premium of $3,000 plus the par value. After the June 30th interest payments, the bonds have a carrying value of $104,500. So of this amount, this premium that we're going to identify here in the transaction, $3,000 of it's related to the call premium. So let's go through this to start with. So to pay this bond off, we actually need to pay $103,000. That is the face value plus the call premium. So we're going to identify that here, $103,000 as the credit. That's what we're paying out. We're going to identify the debit to bonds payable here as $100,000. Now, one of the things that we also need to recognize is that built into this retirement, these bonds had a carrying value of $4,500. That means that we still had some unamortized premium left. So even though we paid a premium to call them, we still had some unamortized premium. We sold these at a premium. Whatever premium is left, we need to recognize that as a premium. We're going to record that here as a debit to close that out. Remember, a premium is going to be a credit. So here we're closing out the remaining premium of $4,500. And so what this leaves is $104,500 here and $103,000 here. What that means is we then recognize a gain on the bond retirement of $1,500, the difference. If this difference would have been reversed, if this would have been the $103,000 would have been greater than the total of these two, you would have had a loss on the bond retirement. But in this case, this is actually less than the bonds payable and the premium that you have on the books. Anyway, the difference then would be the gain. So there's another way to retire bonds. Sometimes bonds are convertible, and what that means is when you issue the bonds, bondholders or bondholders of record have a right to convert their bonds into common stock, usually. What happens when this occurs is you basically transfer the carrying value of the bonds that are converted into common stock. So what you're going to do is this. You have a par value common stock, $2 par value per share. What it says here is the conversion allows for this $100,000 of bonds to be converted into 15,000 shares of $2 par value. What that means is you're going to close out the bonds payable, but in the equity section of the balance sheet, now you're only going to record the par value of the common stock as common stock. So the par value here is 15,000 times 2. That's going to be $30,000. But because we have a greater amount here, and actually those shares, that $2 par value for common stock doesn't necessarily reflect its actual value. The actual amount that's being allowed here would probably reflect that more commonly on the market. But because of the way we account for stock, we're only going to record this as par value in common stock. Instead, what we're going to do is to call the difference, the amount above par value, paid in capital in excess of par value. That's really going to show how much more our stock is worth than the par value. And basically the two total here are going to indicate the value of our capital in equity. Okay, another, by the way, they have a little insight here into junk bonds. These were very popular a long time ago, and they were bonds with very, very low credit ratings, and many of them didn't really repay their obligations. But anyway, sometimes they worked out well, and so investors were able to get quite a bit of money out of them, but that was a high-risk venture. Okay, let's go on. Long-term notes payable. We're talking about that. We're talking about something where we borrow money for an extended period of time. An installment note, perhaps. This is going to be over a period of greater than a year. So we borrow money like from a bank, and we're going to make some installment payments back. And basically it spreads those payments out over an extended period of time. So here, a company borrows $60,000 from a bank, signing an 8% note for 3 years. They record the issuance of the note like this. They debit the cash and they credit the notes payable for the amount of the note. That's what they received when they issued the note. Now they're going to pay it back in 3 payments with 8% interest. So each year they're going to pay back. Here's the calculation. You're going to have that each year is going to be $20,000, a third of this debt, plus interest. So you calculate the interest as $3,282 on that amount, on that $20,000. So those payments would all be the same. Normally, though, if you have an extended period of payments, you're not going to have an even distribution of the payments like that. I mean, you will have for payments, but you won't have an even distribution of the interest. So normally there's an amortization schedule like this for an obligation or a debt. So you start with a beginning balance, and you're computing the interest on the entire obligation here at 8% at $6,000. That's $4,800. You're going to add in this payment to notes payable, because the total of this $18,482 and this will be the $23,282. Anyway, so you're going to calculate this interest expense, which is based on this times the 8% times the length of time that it's been outstanding. So you actually have $4,800 in interest expense in the beginning of the period. And then you're going to basically take the rest of the payment, the $23,282 you've already calculated, and that's going to be applied to actually the principal. So in the transaction, you're going to do a payment of $23,282, but only $4,800 or only $18,482 is going to principal. The rest is going to interest. So what you do then is, after you make this payment, you want to compute the ending balance on the obligation by taking the $60,000 minus the $18,482 to arrive at a new principal balance. The next year, the principal balance will be the same, will be the $41,518 you just computed, times the 8% to get, and the length of time to get the interest. you're making the same payment. So this time, instead of 18,000, you're going to have 19,961 apply to principal and the interest that you've computed here. That total payment is what you're making, but this 19,961 is what's going to come out of the principal balance due. And so when you take this minus the principal amount, you're going to have 21,557. This then will be the starting of the computation in year 3, and you'll do the same thing for year 3. Only this time in year 3, you're going to wind up with the entire balance of the obligation being paid as far as the principal portion of the payment is concerned. You will have this interest payment here that's apportioned to based on this payment. So anyway, that's the end of all this calculation. And what you're going to see, instead of a spreading out of the interest over a period of years, like 3 years, you're not going to have an even interest each year. You're going to have an increase in interest in the beginning, but a decline in the end. So the recording of this expense would look like this. So when you actually pay the principal, or when you actually pay the payment, you're going to record the interest expense here, and then the debit, well, it's just a debit of 4,800, and this is for year 1, and then you also have a debit against the notes payable for 18,482, and then the total payment of 23,282. Each year you will take these numbers from the amortization table to record these payments, these transactions. Now, mortgage is an agreement that has security on the long-term note or even the bond. Mortgage bonds or mortgage notes are secured by collateral that the company has, typically by real property. And so you have basically an obligation that you've signed, but you've pledged as collateral for that obligation specific property. And just like with the others, you would calculate an amortization schedule with that. Now, this section has some important information about the different kinds of bonds and so on. So there are 2 kinds of basic bonds. One is a secured and one is an unsecured. A secured bond may be a mortgage bond or whatever. An unsecured bond would be called a debenture and is just issued on the credit of the company. Term bonds are basically going to be for a specific period of time, and serial bonds are going to mature over a series of periods. So you may issue one bond issue, but it may retire in sections. So, for example, when I was working on one particular bond issue for a large hospital, they issued a $35 million bond issue, but that bond issue was set to retire in 3 series. So the first series was Series A, the second was B, the third was C, and they had these retirements set up at different periods over the life of the bond. So that's what they would. That's how they scheduled that out. They would basically say, we're going to borrow this entire amount of $35 million, but then we may have 12 million retire at this time, 12 million retire at this time, and then 11 million retire in the last series. Bonds can also be registered, which typically they are, and it's more secure to have registered bonds where you have bondholders of record, and the issuer can then make these automatic bond payments to whoever is the bondholder of record. But there are another type of bond that's called bearer bonds, and these bonds typically have a no name registered with them. They're basically good for the person who's carrying the bonds into the institution where they redeem them. So if these bonds are issued without a name or without a registration, they're called bearer bonds. They may be referred to as coupon bonds because in the old days they used to have a coupon around the edge of the bond that you clip off and take into the bank to claim your interest. Typically that's how they would do that. And by the way, bearer bonds are probably a little less secure because anybody who has the bond itself can actually collect the interest or collect the money when the bond is due. We've already mentioned the convertible and callable bonds. Those are very common. It depends on where you're at, but callable bonds are very common because a company doesn't want to get locked into a very high interest rate, and they may issue a set of bonds and then call them and actually reissue another set of bonds. Okay, so then you have this idea of a debt to equity ratio. And basically the debt to equity ratio is the balance between total equity and total liabilities in a company. The goal is to find the best ratio, the best relationship between those two, and operate at an optimal level of debt to equity. Here you see these ratios over a period of time. What they would be a debt to equity for Nike, for example, started out 58% in 2013, 2016 at 75. Under Armour was 50% in 2013, 79% in 2016. So again, those structures do change over time, and it may be for good reasons. And that debt to equity ratio, a company can calculate the optimal operating level. So here's a good example for the need to know, a comprehensive example for the chapter. We'll go through this stuff when we meet, but I wanted to give you this video to kind of give you an introduction to this material. And we'll cover all the way up to here. We'll talk about how bonds work and so on. And I look forward to seeing you next time when we really get into these problems and look into this a lot deeper. Thank you.